Well, hello everybody and welcome to this webinar on the exciting subject of community infrastructure levy. What I'd like just to do is give you a few housekeeping points. One of the things that we want you to do is to pose your questions as we proceed through the presentations. You should have seen, and it's on the screen now, a telephone number. You can text questions, and you can text any problems that you may have, but you should be able to use the chat box to pose any questions that arise. And just to make a note, that text number is 0777 551 0224. So my name is Colin Peacock, and I am a founding director of Swallowfield Homes. And we are a recently created vehicle for the purpose of partnering with institutional investors into the affordable housing market to enable the delivery of new homes at scale. So I have spent something like 50 years in the real estate industry. And it's fascinating to me that during that time, I realized that at no point have I known everything about everything. And sadly, I have to confess, I'm not sure there's ever been a point when I've known everything about anything. But one thing I do know is that when you need to find a way of solving challenges or problems, there are people out there who do know pretty well everything about something. And the task for developers is to bring those skill sets together, and that is what Alan Oliver and E3 Consulting have sought to do today. So the object of the exercise here is to take 4 presentations that will embrace skill sets in the law, architecture and design, planning, and tax advisory. It's not my intent to give you an overview of each speaker, but rather for them to introduce themselves and then to go through their presentation with you. There will be no questions as we go, but by 2 o'clock we hope we'll have concluded the proceedings in formal time, and that you will have an opportunity then of debating with us points that have arisen. So it's a pleasure to hand over at this point to Matt Julks, who is the Senior Associate Solicitor at Thrings LLP, is going to tell us something of the thrills and spills in the world of CIL.
Thanks very much. Yes, so thank you very much for that, Colin. My name is Matt Julks, and I'm a Senior Associate Planning Solicitor at Thrings. And we've got a team of 6 planning and environment solicitors across our Bristol, Bath, Romsey, Swindon and London offices. And we advise on all sorts of aspects of planning law, planning applications, appeals, procedure and decision making, and on infrastructure, Section 106 agreements and CIL. We deal generally with small to medium house builders, and we work with other teams to advise on strategic land acquisitions all the way to build out and plot sales. I'm fortunate to have practiced for over 20 years, and I'm happy to say that we've saved our clients thousands of pounds in CIL. So what is CIL? Let's look at some amazing, the amazing world of CIL. So I'm going to start off with a sort of an analogy. Minos, the king of Crete, required Daedalus to create a labyrinth to house the half bull and half man known as the Minotaur. And the Athenians were forced to pay the Cretans a regular tribute of 7 boys and girls, and they were left in the maze to be eaten by the monster. So one year Theseus, the son of the king of Athens, was sent to Crete as a tribute, and he killed the Minotaur with the help of King Minos' daughter, Ariadne, and found his way out of the dreadful labyrinth. Well, rather like the king of Crete, the government created the labyrinth of community infrastructure levy in order to capture the monster of planning game. But in the world of CIL, the developers are the Athenians, and the unwary may find themselves being sent into the maze to be eaten by the monster. So the world of CIL is full of thrills and spills. Thrills if you obtain a discount, and you're sure to lay a careful plan or breadcrumbs that allows you to ensure you can find your way back through and out of the maze. Or spills, if you don't ensure that you've planned your strategy and got the right help. So in this talk, I'm going to set out very basic principles, CIL, and then I'm going to set out an example of the case in the courts to demonstrate how important it is to take it all seriously, and then update you on the most recent regulations. I'm aware that I'll be speaking to an audience with various levels of familiarity with the levy, so please forgive me if this is too simple. Okay, so can I have the next slide, please? So what is the community infrastructure levy? And what are the basic principles of CIL? Well, the levy is a planning charge intended to support the delivery of infrastructure, to supplement or sometimes replace Section 106 agreements, and it was introduced by the Planning Act 2008. Regulations came in 2010. It's a funding vehicle for authorities in England and Wales, intended to deliver infrastructure, support development in their local area, and in most cases, the local planning authorities, the charging authority, and the collecting authority. Came into force in April 2010 through the Community Infrastructure Levy Regulations 2010, and a good measure of how complicated the levy is to operate, understand, and deal with is that the original regulations have been amended now 11 times, just in over just a decade, most recently to deal with the First Homes Policy Initiative. So those amendments were simply attempts over just more than a decade to make the levy workable, comprehensible, and equitable. So it's a system that must be voluntarily adopted by the local planning authority in each area, and it means rates can vary. Some authorities may not apply CIL for certain uses or at all. Rural authorities are very reluctant often to impose the CIL. And a recommended practice for an owner or developer is to decide or agree who's to assume liability at the date of the making of the planning application. But it's important to be aware the liability may be transferred to allow for property transactions. So development agreements, options agreements, things like that, CIL's got to be taken into account then, right from the start. Okay, so just moving on now to the basics. In summary, new buildings or additions to buildings that create net additional gross internal area of 100 square metres or more, or any new dwellings, are potentially liable for CIL. And some developments may be eligible for relief or an exemption from CIL. But behind that rather straightforward statement are complex formulas, procedures, and notifications that have tripped up frustrated developers, both large and small. And the local planning authority must introduce charges by a process of local examination, similar in nature to the local development plan process. And levy rates are expressed as pounds per square metre. For example, Woking Borough Council's rates might range from £365 per square metre for new residential floor space to £50 per square metre for some retail floor space. Other kinds of floor space, there may be no charge. An authority must strike an appropriate balance between the desirability of rates for additional investment to support development and taking into account other sources of funding, and on the other hand, the potential effect of rates on the viability of development coming forward at all. So these charging authorities must be able to show and explain how their proposed levy rates will contribute towards the implementation of their relevant plan and support development in their area. Now, moving on to the next slide about exemptions and reliefs. Now, these regulations allow for certain developments such as structures, extensions, or additions to dwellings or self-built housing to be exempt or gain relief from the levy, but the procedure to secure and keep exemptions throughout the life of a development is onerous. It's important to get advice right from the outset all the way through. The 2010 regulations include clawback provisions to ensure there's no escape from payment if the CIL provisions are not followed. And in essence, the general position is that the developer of a potentially exempt development ought to submit, for example, a commencement notice to charging authority prior to the start of works. The idea of this is it determines the start of the clawback period in which the exemption may be removed if a disqualifying event occurs. But of course, then you've got the issue about, well, which notices have you got to ensure you submit before you even start works? So the regulations also allow, in certain circumstances, the internal area of an existing building to be considered in calculating or sometimes discounting the chargeable amount. And the other thing to bear in mind is that every time a new planning application is made to amend an existing permission, that may change the levy payable. The questions are often how the amount of levy be calculated, over what area, from what time, and at what rate, and what indexation. Lots of questions arise about outline planning permissions and reserved matters approval. So sadly, the scope for confusion is endless. And this is precisely the reason why it's essential to obtain professional advice from planners, surveyors, across the board, tax experts, the whole thing. You've got to flex your network in the development industry to ensure you understand the parameters of CIL. CIL isn't like the rest of the planning system on which I advise. It's where the courts can ensure a fair crack of the whip to ensure justice is served if the code is deficient, or it's got a gap, or there's an error by a developer or the local authority, and there's an opportunity to more often than not, sort things out. CIL is more akin to the tax code. It's unbending, it's unforgiving, and it means the implications of misunderstandings or errors are, for the most part, irreversible. So moving on to appeals, another thing to bear in mind in terms of appeals, on the next slide, is that there are a lot of appeal routes, but they're all very technical. And you can see on this slide, appeals made in connection with the calculation of the chargeable amount or self-build exemptions, for example, have to be made to the valuation office on a form provided by the agency within 60 days. Appeals related to enforcement, surcharges, commencement notices, stop notices should be submitted to the planning inspector. Some must be made within 28 days, others within 60 days. It truly is a maze for the new user. And it just doesn't fit well with the rest of the planning system, for which there are, generally speaking, broad appeal or application deadlines of 6 months, 3 months, 6 weeks, or in some cases, 28 days. So you're dealing with a completely different animal. Moving on to penalties and surcharges, and this slide is just to point out here that the regulations provide for a range of enforcement measures. And just get to the slide. Next slide, yeah. So these range from surcharges on late payments to direct actions such as stop notices, and in some cases a person can eventually go to prison for up to 3 months. So it can be quite problematic, one might say. If the authority cannot recover CIL from the person who assumed liability, the authority can pursue the owners of the land. So getting everything buttoned down in relation to your deal is very important. Now I'm going to just go to the next slide, Guardiano. Now I'm going to run through this interesting one now. It's from a couple of years ago, but the reason is that it illustrates the complexity of the levy. And bear in mind, it may not apply to the precise set of facts with which you are grappling. So in this case, the Court of Appeal had to consider the true interpretation and the effect of that Regulation 40 up there on the slide. So no community infrastructure levy is payable for retained parts of a relevant building where the intended use following completion of the chargeable development is a use that's able to be carried on lawfully and permanently without further planning permission in that part of the day before, or in that part on the day before planning permission first permits the chargeable development. In other words, there's a retained parts discount for CIL if you retain parts of the building that you've worked on in certain circumstances. So the developer appealed against the High Court's decision of December 2018 to uphold the decision of Camden Council as the CIL collecting authority, in which it confirmed a notice of liability to pay CIL in the sum of £547,000 odd, issued in January 2018 for premises at Windmill Street in London. And the history here is there were 2 relevant planning permissions, one for a development of 6 flats granted in May 2011, for which no payment of CIL was required, as CIL had not been introduced in that local area at the time. That was live and partly implemented on the day before the relevant date, which was the 21st of June 2017. Now, how do we get there? Well, the rear extension alterations to the elevations of the building were completed and steel beams fitted inside. The first, second and third floors were stripped out and left unpartitioned. By then, the developer had preferred, by that time being done, and implemented, they preferred a scheme of 3 larger flats to the 6 smaller ones they'd already approved. So on the 22nd of January 2016, they submitted another application for planning permission, and in that application, in the form, current use of the building was said to be residential. It explained the building was vacant and that its last use had been as a warehouse until the 1st of December 2010. So the development for which the council granted planning permission on the 22nd of June 2017 was for a development of 3 flats granted on that date. And this was after the council had introduced its CIL charging schedule. So CIL was in effect, and the use that will be lawful under both these planning permissions is the same, namely use as a dwelling house under C3, residential. So the issue was, if the effect of the regulation 40 was to reduce to nil the amount of CIL payable, because on the relevant date, under the planning permission of 2011, the building could lawfully be used for the same purpose as that permitted in 2017, residential use. So what it boiled down to was, what, in the council's view, the wording able to be carried on lawfully and permanently without further planning permission in that part meant the floor space should have already been built out without further physical changes. And the High Court agreed with that, said the council had been right to find conditions for a statutory deduction from CIL were not satisfied because the first, second, third were a mere shell without any facilities and incapable of being used for residential purposes. So there we are, eminent judge in the High Court. The Court of Appeal disagreed. Court held the natural and ordinary meaning of an expression of use that is able to be carried on lawfully and permanently without further planning permission, when construed as a whole, meant the ability to carry on the use in question did not depend on the building actually being occupied in that use on the relevant day, or upon it having been physically adapted for that use. It was enough that there was the possibility of the use being lawfully and permanently carried on. And the right to carry on the use need not have been exercised yet. So thanks for bearing with me on that one. What I'm trying to demonstrate there is, I'm not expecting you to retain any of that, but it demonstrates how complex CIL is to interpret, so that even senior experienced judges in the planning court and then the Court of Appeal come to different conclusions on the text of the same regulations, which can have a massive financial implications for developers and for councils. Just I think my last slide now, recent changes. Finally, please be aware of these recent changes. The government published guidance on the 13th of May 2020 on the flexibilities available to CIL charging and collecting authorities to defer CIL as part of a wider package of coronavirus related planning guidance. In July, coronavirus regulations amending the CIL regulations came into force. They allow councils to exercise discretion up to, I think, the 31st of July 2021, during the period ending at 31st July 2021, to agree to a request to defer CIL payments in certain circumstances if they consider it appropriate. Don't quote me on this, but I think it only applies to developers with an annual turnover of £45 million or less, and they can make that request, but there's a lot of discretion there. So it also allows the disapplication of interest for a limited time, late payment interest surcharges, but it's all discretionary. In November 2020, further regulations came into force to extend the existing relief for social housing to incorporate the First Homes initiative. So it's important to keep up with things because they change all the time, and also important for you to ensure you keep up with the planning bill, which will be introduced into Parliament in the summer, as there are big changes on the horizon for infrastructure charging in the pipeline. So I'm now going to, after that, thank you very much for listening. I'm going to pass the baton on to Duncan for the next presentation on the architect's perspective.
Thank you very much, Matt. Hopefully you can all hear me. So my heart rate's gone up after that presentation, Matt, and I can't work out if it's because I'm about to do a presentation or it's because you're using words like CIL, chargeable, irreversible, PRISM, and £500,000 in tax, but we'll soon find out. Hello, my name's Duncan Mclaren. I am the founder of Studio McLeod, which is an architectural practice. I suppose by way of introduction, our practice is involved mainly on residential projects for homeowners and select developers. Regarding planning, I suppose through our design approach and experience with a good healthy dose of good fortune, we've managed to maintain a 100% record of getting our clients planning approvals. However, when it comes to CIL, unlike the other panelists here today, I'm certainly not an expert. And that's important for us to acknowledge as architects, that we need to look to experts. I suppose people look to us to be experts of everything building related, but the industry is so complex now. And as Matt was saying, it's ever changing, that we need to recognize when we need to bring in expert advice. I'm therefore going to present 3 projects to you, 3 scenarios. If I could just change this slide, there we go. Whoop. I'm going to present 3 projects to you that our practice has handled. Bear with me. And I'm going to present them as the easy one, which we would say is code green, where everything is seemingly straightforward. The tricky one, which we would say is code amber, where the situation is a little more complex, and we would recommend specialist CIL advice. And then unfortunately the nightmare one, which I've called code brown, well, where things go a little bit pear-shaped and things start hitting the fan, everything goes wrong, and you need to bring in the experts to fix it. Thankfully, we've only had one of those to date, and thankfully it wasn't due to our performance. So top right there, clients approach us for a variety of reasons. I'd say the main project considerations are firstly design, to fix their problems, and hopefully something that improves people's health, happiness, and well-being. In amber, certainly very quickly people want to understand cost, timeline, and planning considerations. But also CIL can affect all 3 of those quite considerably. So we always suggest raising that to one of the top project considerations. And in the graph below, just a simple exponential graph of fear. Not dealing with it early on will certainly increase stress, risk, and cost exposure, both to the client and to architects and other consultants involved. And the financial implications of getting it wrong are so scary, as outlined in Matt's presentation, that you want to make sure that the client gets the right level of advice. So firstly, the easy one. These are nice, these ones. Excuse me. This was a new build house on the site of a client's existing garage. When this was described by the client as her forever home. So all going to plan, it would certainly be more than 3 years. And therefore, that would qualify for a self-build exemption. And so in this situation, we're able to use our standard checks and processes and proceed with an application on her behalf. So we would call that a code green, where with little or no input from a CIL advisor, we feel competent and able to handle a project such as this. The next one is coined the tricky one. This was a large townhouse property. This drawing is, or this image on the left is not of the property. It's a random property, so nobody can identify it. But this was 2 flats in single ownership. They were bought by a client where the client was to live in the upper part, which was the blue element, a nice big area. And their nanny was to live in the smaller flat below, the duplex there in grey in that little section diagram. The larger flat was being extended by over 100 square meters with a basement, and the smaller flat was being actually reduced in size. And as the client would be living in the upper flat, and the smaller flat actually wasn't getting any bigger, it should qualify as a residential extension exemption. But as the project was in RBK and C, and we could tell by the early stages that this project was not going to get any simpler, we thought that that it was possibly a code amber, and that we should bring in a CIL advisor to be consulted throughout the rest of the project. And so in this scenario with the client and the CIL advisor, it was agreed that we would process the applications and the notifications, but it would all be done under the advice and liability of a CIL advisor. And then as the project went on, there were multiple planning applications, which complicated the pre-commencement notifications. And then there was the inevitable pressure to start on site ASAP. So we had to negotiate what the contractor could and couldn't do. So what the relevant pre-commencement works could be without triggering a start. And then towards the end of our involvement in the project, the client decided to then sell the property on as a going concern, which then complicated the assumption of liability. So needless to say, we were very happy here to have the support of an expert throughout that. So all ended well for the client on that project. And then with a deep breath, I'll go on to the nightmare one. So this was a new build house, which is to be redesigned following significant fire damage. It should have been straightforward. It should have come under self-build exemption, as it was for the client's own home. I suppose it starts to go downhill on this slide, as the project was to be self-managed and the client had little construction knowledge. Prior to our involvement also, we understand that CIL notices for previous planning applications that she'd done with previous architects were received but filed somewhere and not actioned. And then they arranged to have the house demolished without serving any notification. And we were brought in around this stage to look into a pre-application to see if we could design something more contemporary and more architecturally beautiful, I suppose, than the previous designs that were put together by a different architect. And so we were then appointed to submit the planning approval for the new house, which we got. And then unfortunately the client notified us that they had received a CIL payment request, as they had demolished the building without the requisite notices. So they called us and they were obviously very, very panicked, asking us what to do. And their stance was that obviously the house had significant damage by the fire and was at risk of collapse. And so we would call this situation a code brown, where things start to get a little bit scary. And so immediately we recommended Alan of E3 Consulting to handle that situation for the client. And they managed to save the day. They were able to carefully negotiate the situation with the council, and got full relief for the client on that. And I suppose with something like that, all of that could have been avoided if they had appointed consultants to manage the project, if they'd have either appointed us to look after it for them earlier on, or given their previous architects or project managers actually the role and responsibility to look after that project for them. But for whatever reasons, usually financial, that was not the case. So I suppose to leave 3 bits of advice. Advice number 1 would be know when CIL could reach a level of complexity that you may need expert advice. Advice number 2, consult those experts as early as possible. And piece of advice number 3, based on the final slides, if somebody who isn't a CIL expert says they have everything under control, strongly refer them back to points 1 and 2, usually immediately, and usually or certainly put it in writing. But thank you very much for listening to those. So next I'm going to hand you to one of those CIL experts. Here's Helen Rozier of Tana and Tilly Planning Consultants. So over to you, Helen.
So hello. As Duncan said, I'm Helen Rozier from Tana and Tilly. Just a quick introduction about us. We are a small planning consultancy based on the South Coast. We are RTPI accredited, so we are chartered town planners and follow the code of ethics from the RTPI. We're an independent consultancy, and like I said, based on the South Coast, where we do all sorts of projects locally, but we also work nationally on care home projects. So this would cover care homes, extra care and supported living developments, which we have a specialism in. So we would run planning applications for those, but we also provide care needs assessments and sequential test assessments and other specialist reports because care is quite niche. So there's only a handful of consultancies that have that expertise. We also do normal residential development, so anything from householder appeals where people need a bit of professional advice and help to larger sites comprising sort of 50 or more homes and everything in between. We do commercial developments, which is quite frequently changes of use and permitted developments. Obviously that gets caught up in CIL, and longer term strategic site promotion for larger sites. So I understand that many of you will already be familiar with the CIL process, and I'm going to give a really whistle-stop tour through the process because there's quite a lot of stages, so I'm going to cover things quite quickly. Before I'm going to then highlight some of the common mistakes that are made, as well as just run through a few case studies on how you might be able to minimise your CIL liabilities. And I understand that slides are going to be circulated afterwards, so you can have a bit more of a thorough read through all the information because there's quite a lot on my slides. So CIL involves a number of stages, all of which are a legal process and which must be complied with. And as you'll see as we go through the slides, there really is a need to do things right, and crucially, to not start work before you have everything in place, as you'll have seen from Duncan's examples as well. So if things are not done properly, you can incur penalties such as surcharges, which can be up to £2,500, but potentially more damaging is the loss of any rights to claim to have your payments in instalments, or you'll lose your right to relief or exemptions at all. And just to note, I've set out these in stages, but there are elements that overlap and stages that can run concurrently with one another, just to try and make things simple. So stage one, you're probably all familiar with this document. It's your CIL additional information requirement form, which will go in at the time of submitting your application. So this is the starting point for the LPA to determine whether you are CIL liable and to calculate the chargeable amount. So simple pointers: fill the form in carefully, read it thoroughly. It will guide you through on the form the information that's required, including reliefs and exemptions. In terms of the floor areas, you need to be recording the proposed gross internal area, not external. So don't put the external, you'll be paying more than you need to. And where you've got existing floor space, where possible, make sure that you've included everything you can under that existing floor space, because as it's been explained, that'll be offset. And then whistling on to stage number 2, you also need to submit your assumption of liability form. So if you know who's going to be liable for paying CIL, why not submit this at the same time as your planning application documents? Technically, this can be submitted any time between the submission of the planning application and commencement of the development. But if you've got it, do it up front, it's easy and it's done. You can withdraw an assumption of liability and also transfer it. So for instance, if you sell the site, and there are, surprise, surprise, yet more forms for this, but note that if you have assumed liability and apply for and then receive relief, which you then and you then want to transfer liability to another party, the relief will not transfer and the new party will still be liable. So following the transfer, the new liable party will need to apply for relief and provide all the necessary evidence, as you will have already done. So that doesn't automatically transfer. Stage 3. So once you've received your planning approval, or in the case of permitted development, when you've submitted your notice of chargeable development, the LPA will then issue you with a CIL liability notice. This will be issued at the same time as your planning approval, or as soon as possible following the decision. Here is the first place that the LPA can potentially trip up on the CIL process themselves, which I'll discuss at the end when we touch on the Herzmia case. The liability notice quite simply just sets out the amount that you must pay for CIL for your development. So crucially at this stage, check your notice. Check that it's been correctly issued to the right person and to the right parties, and contains all the right information and the information you're expecting to see. If it doesn't, then that's when you need to consider doing the regulation 113 review, which I'll get onto shortly. Stage 4, applying for relief or exemption. You can do this really early on. So technically, you can submit your CIL additional information form, your liability form, and your relief and exemption form all up front when you're submitting your application. So if you are self-building and you'll know you're going to claim the self-build exemption, you can submit all 3 forms up front. To apply for the relief and exemption, you must have already assumed liability for paying CIL on the chargeable development and apply for relief before the development commences. Do not start work until you have received the determination of relief from the council, or you will forfeit the right to the relief. Relief will be subject to a clawback set period, which I know Alan is going to talk about as well and explain a bit more about. But basically, this means that if a disqualifying event occurs, then CIL will still be payable. So, for example, if you have a residential annex which has received exemption and it's sold or let separately to the main residential property within 3 years, then CIL will be due immediately. And there's other periods of times for different exemptions. And if a disqualifying event occurs, you must notify the LPA within 14 days of the event. Otherwise, you'll get surcharges and penalties and the rest of it. So, stage 5. At least one day, I would advise it to be more, before commencement starts, you must submit a commencement notice to the LPA, and this informs them when the development is going to commence and forms the basis of the dates that the CIL payments will become due. Do not start work until you have received notice from the council. So are we getting the picture? They should acknowledge the forms, and so I would suggest that it's sent by email so you have evidence of sending, or wait until you have something back from the LPA to confirm receipt of this commencement notice. Failure to submit this form prior to commencement or at all, or providing an inaccurate commencement date, will result in the LPA deeming a commencement date. They can also issue penalty surcharges for this as well. If you are eligible for instalments, you will lose the right to pay by instalments. And if you have been issued relief or exemption, you will lose the relief and exemption if you do not do this. If you have submitted a commencement notice and then you want to change the commencement date, you can just submit a revised commencement notice, so it's not tying you into anything. Once development commences, liability cannot be withdrawn, although it can be transferred up until the final payment is due. Stage 6 is the issue of the demand notice by the council. So when they've received your commencement notice, the LPA should issue a demand notice for the persons who have assumed liability for the CIL. And in most cases, shortly after this, you will be issued an invoice separately, which sort of eases the enablement of payment. If the payment is not made by the due date, then they will impose more penalties, surcharges and interest. And the payment of CIL, just to remember, is enforceable through the planning process and also through the courts. So you should probably do it. Stage 7, nice and simple. Once you've got your invoices, you need to pay them, and you should get an acknowledgement receipt from the council. Stage 8, again, this is a simple one for the LPA. Once they've received your CIL payment, providing there's no relief and clawback periods, they will remove the CIL charges from the land charges register. There's a bit more information on the slide there, but I won't go into too much detail because it's more for the councils. So I've put this slide as stage 9, but basically it can happen at any stage, as Matt's sort of indicated before. Where relief has been granted and then a disqualifying event occurs, you must notify the LPA in writing within 14 days, and failure to do so will result in a penalty surcharge. And the LPA, once they've got that, will then issue a liability notice and a demand notice for payment. So that's the process. So look at some of the common mistakes that you need to avoid and things to look out for. Before you apply, check if you can minimise your CIL payment. So you can, we would always advise seeking advice at this earlier stage. Fill the forms in accurately and take note of the exemptions and floor space that you've got, as I've said before. Make sure you submit the forms at the appropriate time, and crucially, if you haven't already got it by now, do not start work until the relief has been claimed, if you're doing so, and you have served a commencement notice to the LPA, and know what constitutes a material start in your case. So just be aware that if your description of development includes something, for example, like demolition of, then demolishing that will very likely constitute commencement of that development. And if that's done before you've been served notice of commencement, all CIL discounts are cancelled as a result. And if it's a site that involves affordable housing, the scheme will suddenly become CIL liable, and that will not get you out of the requirement to sell the affordable units in the section 106. So make sure everything's in place before you commence development. This is especially key where you've got contractors working for you on various sites and things like that. So easy ways to minimise or avoid CIL is, as we've sort of covered already, offset the proposed new floor space with the existing. So as Matt says, if you've got a continuous lawful use for 6 months in the last 3 years, that floor space is deductible against your calculation for CIL liability. So if you've got a development which proposes or includes conversion or demolition of an existing building, then try to ensure that you qualify for this offsetting. So most applications would take at least 6 months to prepare, obviously depending on complexity. So if the building in question is vacant at the time and you don't currently qualify, can you set up a short-term lease to demonstrate compliance with it? So getting a tenancy agreement in place is great evidence, and it makes your case pretty watertight if the CIL officers question whether it's actually been in use. It doesn't have to be a high rent or an obvious use of the last use. Bear in mind that, subject to caveats and conditions and things, you have flexibility to change use through the new Car C as well. Can you turn your development into something that doesn't incur CIL? I'll sort of cover this in my case studies. Basically reword or rejig your proposal so that it falls into an exempt category. So that normally will fall in with self-build. And talk to and engage with your CIL officers at the LPAs early on in the process. A lot of my associates have said this, that they find CIL officers a lot more approachable and helpful than your typical planning officer, and they will do their best to help you because it is complex and they are experts. So I'm just going to whistle through these case studies. So I asked some of my associates if they had any examples of where they had saved a significant sum for their clients. So this first one was for a residential outbuilding, which a client had proposed a separate outbuilding with a swimming pool, gym and a floor space which was over 100 square metres. And the estimated CIL due was approximately £30,000. But by incorporating the outbuilding to the main house as an extension with a glazed link, it was then CIL exempt. Now, there are instances where you can have annexes and outbuildings which are classified as an extension, but in this case, they found that that was the easiest way to make it clear it was an extension and therefore exempt. The second example was for permitted development. So as I said, you've got a farmer who's got an agricultural building which they intend to convert into permitted development, so the prior approval process. They found someone to let out on a short-term 6-month period, and it can be something as simple as agricultural storage and the rent is minimal, but then that building is in use for the required period of time with an existing floor space which you can offset. The third one was an associate had a farrier who was hit with a CIL bill of £7,500. And at that point, he took professional advice. They had a 113 review. The initial discussion they had centred on the stables being a building that are not normally entered into, but the LPA weren't accepting that. So with more negotiation, it was agreed it could be assessed as a residential extension. So Southboard exemption applied as it was an ancillary use. So again, that's an example where it's an outbuilding, it wasn't physically attached to the property, but it did eventually form just a residential extension. And then the final case study that I've got, I won't go through in detail, but this is just to highlight that retrospective applications can be quite tricky, as the relief and exemptions obviously can't be claimed retrospectively. But descriptions of development can be reworded to include and exclude elements which need to be regularised. But if you've got two sort of separate bits of a proposal that combined would take you over a floor space limit, then you need to try and separate them out. So in this example, they just reworded it, but a similar principle would apply when applying for a proposed development. So if you've got two proposals which in combination tip you into paying CIL, can you separate them? It might involve paying 2 application fees, but that will almost certainly be less than you would pay in CIL otherwise. And then just wanted to explain, once you've got your liability note, your charge notice, then if you the liability notice, sorry, if you disagree with something, that's when you can take it to a regulation 113 review. So again, the development must not have commenced, and do not commence your development until you have a response from the LPA. Even if you think that they've got an error, you need to hold off. You need to apply for this review within 28 days of the date of the liability notice, and it will normally go back to somebody at the council, but not the person that originally dealt with your case. So it would be reviewed by another officer. So this is quite useful in the first instance when you've got an obvious error or mistake on your notice, or you think they've just misinterpreted what your proposal was for. And then just to finish off, I think we're going to cover this probably in a discussion afterwards, but this was quite a recent case, the Herzmia case, which really just highlights the importance of doing things right and doing things in the correct order. So essentially the council had not, there was a whole host of errors in this case. One of the main ones being that the council had not served the liability notice as soon as is reasonably practical. It was more than 2 years after planning permission had been granted. They served it incorrectly, they served it at the wrong address to the wrong person, and the claimant in this case paid the CIL so as to not incur any more penalties or surcharges or interest, but the case found that the payment that she had made of £16,389 did have to be repaid in full because the council had not followed the process in the correct way and in the correct manner. So that's it from me. Obviously, I'm happy to take any questions in the debate.
Welcome to everyone from myself. Might help if I go the right way. For those that don't know me, I'm the Managing Director of E3 Consulting and been a property taxation specialist for nearly 30 years now. We've been working particularly with CIL since about 2014 and worked on a very wide range of projects right across England and Wales where CIL applies. So that's the quick sort of up. Really, our mantra is all about saving people money. Using our sort of property tax background, we will look at things. Sub-brand is to evaluate, evolve and enhance the tax situation. And this was just a small case study of something which is close to Colin's neck of the woods, the Royal Borough of Windsor and Maidenhead. And a client there who had resigned himself to paying £17,000 CIL on the conversion of his garage to a residential unit. And last gasp, he did a bit of an internet search, found ourselves, and we were very quickly instructed, went through the process of looking at it, reviewing it and appealing to the local authority, the 113 appeal review, and we were able to get it sort of reduced down to zero. So he was very, very happy client. So you've heard from both Helen and Matt about the sort of broad context of CIL and the structure and the overview. My session is going to concentrate on how do you actually work out the numbers. And as you can see from this slide, we're really focusing on three key parts. So there's the CIL rate that's set out by the local planning authority in its charging schedule. There's the floor area to which it applies. And then there's this adjustment for indexation, i.e. that is changing it from the date that CIL's schedule is published, which may be as early as 2012, through to the date of planning permission. So just looking at these in a bit more detail, London is a special case. So in addition to the local authority bill, CIL for the relevant London borough of wherever, there is also a mayoral CIL which sits on top of that. And we'll come on to what those rates are. Originally, there was a first run which was from April 2012 through to March 2019, and then they revised it with new rates from 2019 onwards. Next, we have to look at the floor area, and this is determined by what is known as the gross internal floor area, or GIA, and that is the area which is used. Now, we had some interesting debates with one local authority that were not using this as a defined term, but considering it to be the gross area of the building, i.e. the maximum possible area. And in that situation, that was completely wrong. It took us several weeks to get them to sort of understand that this was a defined method of measurement rather than simple language usage of it being gross rather than net. As you can see from the next points, the existing area can be offset, and Helen briefly mentioned that you can adjust your sort of CIL charge by looking at the qualifying area and the qualifying use. So that's one of the key sort of ways and things that we regularly look at for clients is identifying, are the right areas in use. And we do see quite a few errors. Sometimes it's errors down to those people making the measurement. GIA is not necessarily a normal measurement for some people. Sometimes the CIL forms are somewhat complicated to fill in and they're not logically straightforward. And if you've downloaded it in the wrong internet portal, the automated parts of the form may not work. So it all gets rather sort of complicated. The key thing is that it should exist on the date of your grant of planning permission, i.e. not demolished early. And it has to be in qualifying use for its lawful use, not just any use. And there's some case law on that as well, which we may cover in the debate and discussion. So if you've got qualifying use, you have sort of a net additional area. Otherwise, if it's not qualifying use, then you're stuck with the whole of the area sort of qualifying. And then, as I say, there's the ability to update, or the requirement, I should say, to update the relief, to update from the charging schedule publication through to the date of planning permission. And as I say, it's the planning date, which is the key sort of point. Okay, so this is really just a slide to give you some indication of the different rates. These are London rates, and it's, as you can see at the top of the slide here, it's Borough CIL plus Mayoral CIL 2, Kensington and Chelsea, Duncan briefly mentioned, and they are both quite vociferous in how they look at CIL, and we've done a number of projects in that borough. They do sort of push quite hard to try and get their way, but we've successfully managed to have some joy with getting them to see things differently and get a better outcome. But you can see here, by the time you've got the mayoral CIL on top of the borough CIL, it can be quite expensive. The one thing this slide doesn't show is some boroughs and some local authority charging authorities do set out multiple different rates for different types. So sometimes you have zones or bands within a particular planning authority, and they can use that to try and skew where they want people to do certain developments. And you can also see at the side of the slide that it's, although residential is the primary area that's sort of covered by CIL, it does apply also to office, retail, student accommodation, and can apply to other aspects as well. The mayoral CIL aspects, as I say, sort of changed in April 2019, and the ones that I'm highlighting here in red just were enabling a change of rate. And, Enfield and Waltham Forest sort of got a bit of a double whammy, because not only did they get an uplift in the chargeable amount, but they went up from a zone 3 to a band 2. Greenwich went the other way, so got a better result. And at the bottom of this CIL 2 bits, you can see that there's also special CIL 2 applying to office, retail and hotel properties in designated central London and Isle of Dogs zones. I haven't set those out within this talk, just from a context of sort of time and everything. So, but happy to sort of discuss those further if necessary. Outside of London, the rates vary, and I've just picked a random sample of different areas. We've worked on quite a range of these and done projects in most of these authorities. Again, we're just showing the sort of the higher rate out of the possible rates applicable, but you can just see there that from Birmingham is trying to maximise retail. In current climate, that may sort of backfire, I guess. Other places like Reading try and have a fairly uniform rate across most of their sort of different types of building construction and so on. Okay, so we then need to sort of look at how this, how we apply those rates against the areas as such. And you've got the sort of gross internal area here. So we're just showing indicative that we've got a new floor area. We've got it over 100 square meters, just so it still applies, and it's not subject to the minor development exemption if you've got something below 100. And basically the rule is that for it to be qualifying, it has to be in lawful use, as I mentioned before, for a minimum of a 6-month period, any time in the 3 years ending on the date of planning permission. So if we had something today, you could go back to 11th of June 2018, and as long as the building's been in use for at least 6 months in that period, then it's in qualifying use, and therefore you can offset the floor areas. Okay, so just showing how this all works in maths. What you've got here is the areas sort of calculation. We're then using the TPI adjustment. So 333 is the TPI for 2021. And this is the TPI we've assumed for when this local authority adopted. You end up with this sort of mathematical equation, which turns the headline rate from £100 up to £133.20, times our net area, because this is lawful use, and there's a civil liability of 16,500 or so. Taking exactly the same figures, although we don't have existing use as qualifying, and therefore this is chargeable on the entire development, you can see very quickly that the rate has significantly jumped by 50,000 or so. Okay, so just really wanted to then sort of run through some quick case studies for you of projects that we've worked on. On the left-hand side here is a project where developer did what they always do of being unfamiliar with CIL at the time. They basically put in their planning permission and decided to demolish the building whilst they were awaiting their planning approval. Their planning approval subsequently came through, and then they found that they were liable for CIL because it didn't exist on the day of planning permission. They couldn't use the offset, and therefore they ended up with a CIL liability. The next one is London Borough of Brent. This is one where the borough didn't accept initially that the building was in lawful qualifying use. So they charged CIL on the whole building. We did a review of that for the client. We were able to collate various bits of evidential proof and agreed with the local authority that it was in qualifying use, and therefore they only charged CIL on the small uplift area, saving the client 25,000. This is
can I just interrupt for 1 second to say that we're having a problem with your microphone, and it might just be worth muting, taking a second and unmuting, and see if that could sort the problem out, because sometimes you're hard to hear.
I've just tried that. Is that any better?
Let's proceed and pray.
Okay. Technology is always one of those things, but apologies. But hopefully you can all hear me okay, and apologies if it's a bit crackly. So this case study is in the Bedfordshire Borough Council area. A client here was building, turning some outbuildings on their farm into large furnished holiday lets. And, again, initially the council had deemed that these were new residential development and that the buildings were not in lawful use. Plus, it didn't help that on that occasion also the CIL forms had been incorrectly completed, with the areas being somewhat overstated as well. So long story short is we were able to review that, negotiate with the council, submit new forms, agree that they were in qualifying use, and reduce the CIL liability by over £42,000. This project was a more sort of large residential scheme with commercial at ground floor and the basement car park. Again, this was similar to one of the situations that Helen sort of talked about, insofar as it was originally given planning permission before CIL was adopted. Lots of changes over the course of the period of construction, mostly through Section 73 minor amendments. But the last of which the local authority, which was in this case Richmond, decided that they wanted to charge CIL on the last sort of planning change. That was a bill to the client for about £16,000. We did a detailed review of that and ended up negotiating it with London Borough of Richmond and got it reduced to zero. So again, a good result. This one is also London Borough of Richmond, but numbers are somewhat higher. This was a private house very significant sort of basement construction with cinema, swimming pool, gymnasium, and so on. The original CIL liability notice was £360,000, and we got that sort of reduced to zero with a self-build extension exemption achieved, having first corrected the raw CIL number by I think this is probably last of the case studies at the moment. This was Oxfordshire. Again, it's a self-build exemption scenario. The issue here is the architect had originally tried to sort of rely on the minor development exemption, saying that the development was less than 100 square meters. They were doing that by a little bit of sort of subterfuge, claiming the attic was existing floor space, which wasn't the case. We were asked to have a look at it, found that that was the issue. They didn't have any drawings to prove it. We recognised that the local authority would very quickly understand that that was the case. However, we were able, because they hadn't started work, we were able to then do a self-build exemption to get them the saving of £34,000. And as Matt sort of pointed out, that's a criminal offence if you submit things which are, you know, knowingly incorrect on CIL. So really, this is just a quick sort of points to remember. For housing, to get the self-build exemptions, it has to be occupied as your sole or main residence. So, you know, that's absolutely key to it. And, you know, the person making the claim, i.e. assuming liability, as Helen mentioned, has to assume that liability for the build. You don't have to build it physically to get a self. You have to be commissioning it. And there are these clawback periods, which are 3 years for a housing exemption, i.e. building a new home, 3 years for a self-build annex. And then for other sort of issues, there's a 7-year clawback if you get social housing relief, or other reliefs around exceptional circumstances or charities. So those are key there. The other sort of really important point, and one which I think is just down to poor drafting of the legislation, is that for self-build annexes and extensions, you're supposed to be occupying the main residence before work commences. So we've seen some situations where extensions, you know, if someone buys a residential property and is looking to then do a significant extension prior to perhaps moving in, then they may have difficulty getting their self-build exemption extension approved. And ideally, you need to sort of occupy, show that you're occupying, have some proof of that in terms of, you know, council tax or bills or whatever, and then do your applications and then sort of do the extension project. So overall, and across everyone, you've heard that it's a very rigid sort of procedural process, very complex. The intention from today is to definitely make sure that those attending are sort of forewarned and forearmed. Some of it, as you've heard, is very time sensitive. We see a lot of situations where people procrastinate and don't deal with it. So our message is very much deal with it now, deal with it early. The earlier you deal with it, the more options there are. You know, do ask questions, do seek advice, because it's generally poorly understood by a lot of people. So make sure that it's something to look at, and as I say, seek advice early. If you get it right, you can make some very significant savings. But sadly, you know, a lot of situations lead to costly errors, and, you know, for the vast majority of those costly errors, Matt mentioned the sort of PINs, the planning inspectorate reviews. The vast majority of those cases are found in favour of the local authority and denied relief. And then finally, again, as Matt sort of touched on, the planning white paper that came out last year, and again reinforced in the Queen's speech that came out was last month, did highlight that they are now looking to change the current CIL and Section 106 regime to something which going forward will just be known as the infrastructure levy. But there isn't any further detail. So that's all for me now. I shall hand back, that's our disclaimer. I shall hand back to Colin, who will now hopefully into a debate. So thank you very much for your time.
Thank you, Alan. Indeed, thank to all of our speakers. And may I just commend you, because you have achieved our objective of concluding the formal component by 2:10 to give us 20 minutes to go through some questions. Now, I just want to remind everyone that this event is being recorded, and hence, if anyone's asked me a question and wanted to be anonymous, just ping me another note so that I won't mention your name. But I have a few questions I'd like to raise myself, if I might. Both Helen and Matt made reference to exemption for social housing. And I'm wondering whether or not there is a definition in the Act of social housing, particularly because I want to explore whether it includes what we might call affordable housing, shared ownership, or key worker housing. So Matt, that might be one for you. And you're muted.
Yeah. So I mean, the regulations set out. You know, there's a very sort of tight approach there in terms of what, in terms of social housing, and it's something really that because at the moment there's so much. There's a lot of change around social housing at the moment, and this is where you've got to be careful to make sure that you're lining up precisely exactly what your product is before you get into a situation where you've made a mistake. But yeah, I mean there are specific exemptions for social housing relief.
Helen, was there something you wanted to add to that?
Not really. I mean, I think
fine, because then we have a supplementary then. So this has obviously stimulated some thought in the audience, as Carl Timberlake asks, so what redress does a registered provider have where a local authority suddenly refuses to allow discretionary social housing, CIL relief, on non-Section 106 plots, which the provider has voluntarily elected to develop out with an affordable tenure supported by Homes England grants? And that's a really interesting question.
I think that's quite a sort of technical point.
Pretty complex one.
Yeah. I mean, the principal redress with any bits of CIL is really sort of to start with this 113 review. So if you're not happy with how they've done it, you can review that. That's a 28-day sort of requirement after the review notice. If you're not happy with their response, and they have to respond within 14 days, you can then take it to what's known as an appeal under 114, which is basically with the valuation office, and that can be done should be done within 60 days. So that's probably the headline sort of CIL requirements, but there may be some other planning issues that Matt or Helen want to add to on social housing type stuff.
Alan, does that guide us to the view that if one is contemplating the delivery of additional affordable housing over and above the requirement under a Section 106, that you ought to actually get to a legal agreement with local authorities regarding CIL before you start? And is that possible?
I mean, the requirements with CIL, as we've heard throughout, is you need to agree anything in writing prior to work commencing wherever possible, because the minute the project starts on site, the review, the challenges, the appeals, and any other relief and exemptions are largely closed off to you or very problematic. So absolutely, the earlier that you resolve it, the better, and preferably before work starts. We've done a number of social housing relief projects, and the rules are quite complex. They do sort of set out, one of the issues is that you have to ensure that the right entity owns the land prior to the project starting and prior to the social relief being applied for and thus granted, assuming it meets the other criteria. So it can be sort of very, very problematic, but it is a complex area. there are, and as Matt says, there's been a number of changes, not least that they've just introduced the new first homes exclusion. So if your project includes some properties that may sort of come under the first homes category, again, that's a separate area now within the CIL regulations to get an exemption around those also. So, that's something that people need to think about. But the earlier these, the better.
I'd agree with Alan. I mean, it effectively is an obstacle course. The regulations change a lot. If you look at Regulation 49 of the 2010 regulations, talks about when you can get social housing relief, and it just goes on and on and on and on with so many things you have to get right. You have to be in a certain category. You have to get the rent right, and all these things. So it's critical, really. It's really a forensic exercise from the start to have a strategy as to what you are going to deliver, how you're going to deliver it, and what you need to deliver it from the outset. Because if you step outside some of these, and it's not just from the start, as people have discussed, it's as you go along. So if you're you've got to make sure that you're matching what you thought you were going to deliver and what you end up delivering with whatever it is going to be satisfactory to the charging authority. I suppose you'd say it has to be choreographed very carefully.
Well, now this is interesting, and this is obviously a hot topic because Carl advises that to assist. He wants to make reference to the fact that this is an emerging situation in Wealden local authority, which other local authorities are watching. Social housing relief is available on the Section 106 plots, but in this local authority, like some others, social housing relief is only discretionary on the non-106 plots. This is causing major viability problems post-land completion for registered providers. So, I mean, there is clearly a point of anxiety there, and it advises us that you've really got to pick this up very early on and agree with the local authority what it is you're going to do and what they're going to seek. And it does go to the heart of viability, and I can see that. Can I just turn to another question from David Gearing? He wants to pick up on comments made about custom build. So, question to the panel is this: do any of you have any experience that you can share with custom build shell and core by an enabling developer? So this is where the developers built to shell and core, permitting the occupiers, be they tenants or purchasers, to complete fit out. And then they wish to qualify for CIL exemption as self-build. And he's assuming this is okay, provided they occupy for the minimum of 3 years. So can I get a comment on that, please?
I mean, the only thing I'm going to say, I don't have experience with that in particular, but you do have the ability to transfer the liability throughout the stages until the date the final payment is made. But as I highlighted during going through my slides, if you transfer that liability, as in you've sold, if the developer has sold the plots onto the people who want to occupy and qualify for the self-build themselves, they will have to reapply for any reliefs or exemptions themselves. The relief does not automatically transfer over. And I don't know enough about those sort of circumstances, whether that would also qualify as a disqualifying event, where if the developer has applied for an exemption as a custom build themselves and then is selling it, if that's a disqualifying event, I'm not sure.
And this is where this sort of question, I wouldn't want to give any sort of definitive view because it all depends on the precise facts of the case. But if I read this to you from 54A2, it might give you a sense of how loaded some of these words can be. So self-built housing is a dwelling built by P, including where built following a commission by P and occupied by P being the person who's claiming the self-build housing exemption, as P's sole or main residence. So self-build housing dwelling built by P, including where built following a commission by P. So those words around who's built what, who's commissioned what, will all go back into the question of precisely what's happened in relation to the precise facts of the case. Because obviously, as Helen's indicated, you've got two entities there, which is built, which is commissioned. So it's important to really pick that apart. So I wouldn't want to give a sort of off the pat answer on that, but that's the sort of thing you'd be looking at.
Okay, now Alan, you wanted to add something there.
Just if I may, the issue is the local authority will decide whether the project has commenced or not, and the fear is that the shell and core is commencement of part of the project. So I would say that potentially that could be very complicated unless you've got your people all lined up and you've done the applications prior to undertaking that. That would be my immediate sort of reaction to that type of project and development. But as Matt says, the circumstances can sometimes be more complicated than that. You need to sort of look at the detail as to the start point of and whether any other aspects could be factored into how the CIL rules are going to impact it.
This is actually really kind of interesting because I seem to recollect that in about 2014-15, the National Self-Build Association did a survey and discovered that more than 1 million people in the United Kingdom aspire to self-build their own home. However, when you dig down, they didn't actually intend to lay bricks. What they actually wanted to do was to have the house provided that suited their specific need. Because frankly, the view was that in so many cases, the major house builders don't build the product that many people want. Perhaps accommodating specific needs like a family member with disability or a specific hobby that requires a certain amount of space or working from home. So the expectation was that a lot of people wouldn't actually build it. And in fairness, on a site allocated for self-build, you couldn't possibly have 50 individuals coming on site at weekends to do a bit of building because it wouldn't fly. So what actually happened as a consequence of the research they did with a government department was that the planning rules were changed. And Helen, you might comment on this, because I understand that in a local authority, they have to keep a record of people aspiring to self-build, and where the quantum is sufficient, they have to make provision in the local plan for land allocation for that purpose. Is that correct?
They do, yes. So each local authority is obliged to keep their self-build register, and then they have to take account of that when they're preparing their local plans. I think there was some recent research that in general, there's a lot of demand. There's long registers at almost all local authorities, and there's just not provision for it. It's not. I think it's one of those, neglected areas of planning.
So one of the things that I've been doing is talking to some of the strategic land providers who think that there is potential to accelerate the rate of build on their sites by allocating elements of them for self-build. But in truth, the self-build will almost certainly be by a contractor, with someone building a specific product in accordance with design guidelines, as distinct from multiple people getting on site and building their own house. Anyway, we probably exercised that one to death. As a matter of interest, you were saying that it's not the local authority's obligation to raise CIL, and not every local authority does. Do you know what percentage of local authorities have a CIL program policy, and what do the ones that don't do about funding their sort of common works, enhancement, schools and the like?
If I'll take that one if I may. I mean, the current percentage is about 70% or so who have adopted across sort of England. The percentage in Wales, I think, is nearer 33%, but there's only 9 local authority zones in Wales. those are the ones which I think as of probably February or March this year was last time I sort of checked and looked at an update. There are probably increasingly sort of had been people looking at adopting, but last year there was only I think 5 or 6 that were new adopters, but various local authorities have reviewed and reissued a secondary CIL charging schedule. So it is changing, but I imagine following the white paper and confirmation in the Queen's speech, probably everyone's probably going to be on pause until they see a bit more from the government as to the proposals for the new version and how that's going to impact.
Thank you, Alan. Now, Richard has just sent his apologies because he's now going to leave because he's got another meeting like so many of us. And I think, therefore, it's incumbent on me to bring this to a close at 2:30 so that we allow everyone to get on with the rest of their busy schedule. Before so doing, I want to remind everybody that we will be issuing a feedback form. That should go out today, and we'd welcome your comment, good or bad, because it enables us to enhance what we might do next. Video slides will be available from Monday. So indeed, do be in touch with Alan's office if that's something you would like to have access to. And maybe actually, Alan, it's something that we could make available on the livery company website for the benefit of those members who've not actually been able to join us today. I was rather hoping, to be honest, that I was going to get a do-it-yourself kit as to how to solve CIL for myself. And what I've realised is I know more now than I did at the beginning, but I also know that I'm never going to try and manage this alone. But what I now also know is that a number of people are there to help me. And so that's wonderful. And may I just thank all of you for all the time you've taken in preparing and delivering. And I very much look forward to discussing aspects of this with you again in the future. Thank you all for your time. And thank you, the audience, for being with us. I hope you found it valuable. Farewell.
Thanks very much.